I think we're wait, what? So sorry. Why is oh, okay, perfect. We're live. Hi, Jack. Welcome
Amazing.
to Venture. Hi, Jack. Welcome to Venture with Grace.
Yeah, it's great to be here. Thanks for having me.
Oh, thank you for coming because you're obviously one of the most famous people in the venture capital Gen Z
I appreciate it.
ecosystem. So, um, so like let's start with you grew up in the Bay Area, and then what are some like lessons that you've learned early on before you got your career into venture?
Yeah, good question. Thanks for asking. Yeah, very lucky to grow up in the Bay Area. It's a good place to be if you like tech. I tried to start a company in high school, so that's how I first got interested in all this stuff. We were building initially an app that would let you share your contact information with someone in the fastest way possible. You know how when you bump your Apple phone with someone else's right now, it'll do that
Mhm. Yeah,
contact
yeah, yeah.
sharing.
Yes.
So it was a fine idea, and then we pivoted to an app that would help you find the best people to meet at events and conferences because we were going to a lot of events and trying to like show people the contact sharing thing, and then we figured out that like if you're going to a conference and there's thousands of people there, perhaps there's like 5 to 10 people that would be life changing to meet. You know, like
Mhm.
they would be you could sell to them as a customer and have your business take off, or you just have a life changing conversation. So we tried to build an app that would look at your background and profiles that you were looking to meet and match it up based on other people's profiles as well. So we worked on that for a bit, and learned a lot and made a bunch of first time founder mistakes as well. So it was a fun ride. Learned a bunch from there, and I did some internships at some other bigger companies and VC firms as well, and just gravitated towards working with smaller teams. So I found Afore when it was just the two partners, and I was interning with them part time, and that turned into full time. Very lucky with the timing.
How I guess like I feel like when I saw your resume, you literally have maybe like 40 different VC firms logo on your resume on LinkedIn. And I wonder like I feel like networking into these ecosystem could be like really tough as a younger person. And then now
Mm,
I've heard like many of my like younger friends, they are very they feel like it's very competitive to go
mm,
into either contrary or dorm room fund, all these kind of like fun or like programs towards younger people. I
mm.
wonder, number one, like how do you kind of like get your foot into the door? And then how do you kind of like build up a really strong network among people who are in like different areas of venture?
Yeah, that's a great question. I think Contrary was the maybe the first like VC thing that I did in college, and was very lucky to be the guy for Boston College for a bit at Contrary. I think what they liked most in the interview process was that when I mentioned this startup that I tried to start in high school, um, there were some other things on my resume at that point, but I think that's what they focused on most. So evidence of like working on kind of side projects. It doesn't have to be like an internship at big tech or at a big VC fund. I feel like evidence that you're kind of entrepreneurial and hustling and in the ecosystem and you know a bunch of founders is most important if you're trying to maybe break in and get the first internship. But it's also a numbers game. There's many logos that are not on my LinkedIn that I applied to and got rejected from. I remember I tried to make a different resume for each. It was the same resume content wise, but I would change the color, the highlight color of the resume to the color of whatever company I was applying to. I just had a template in Figma. So I can actually track like the amount of VC fellowships and jobs that I applied to, and it was like over 100. So there are a couple that that I did get into on LinkedIn, but there were many more that I got rejected from, which is fine. I think it's a bit of a numbers game. You put yourself out there, and then if you can get to an interview and have the interviewer like you for various reasons, then it's kind of just a narrowing funnel. So I would say and cold reaching out cold does work as well. I've got a couple internships that way. That's actually how I found Afore was I DM'd my boss on Twitter a couple times. I think it took maybe the third or fourth time, and then he finally was agreed to jump on a call, and then that call led to the internship, which led to the full time role. So that was a completely cold Twitter DM, and I think what worked there was the DM that I think probably caught his eye the most was when there was a founder that he invested in recently, and I said, "Oh, that's awesome. She's kind of a friend, went to Boston College as well." And so I think if you can show, "Hey, like I know people that you've invested in, or I'm in kind of the right networks," that helps a lot too. Um, yeah. And you can also, general advice is always like do the job before you get the job, which I think you can definitely do. And with venture, that would be, you can start to try and build a Twitter
Mhm.
following if that's your thing, or maybe a newsletter community. You can put out some content if that's your thing as well. It can be short form on Twitter, or it can be long form, maybe like on a personal website or newsletter. You can do business breakdowns. You can do deep dives into industries, and kind of show that you have that deep kind of analysis and diligence skill set. You can also try and become friends with a bunch of other angel investors and try and send interesting companies to VC. So without even working at a place, you can send them, hey, I did this like market research report. I know you guys invest in fintech. I wrote this report on B2B payments. Also, here's a couple of companies to check out. So yeah, you can do a couple things, I think, to um, basically show that you'd be pretty qualified to do the job, and it helps. Yeah.
I wonder, I feel like one of the things that I think you did really well is like you were able to demonstrate that basically your value before that, and as well as like you actually help build these programs within F4. And I feel like a lot of younger people, they could like it could be like very since it may be like their first job out of school, so it would be like hard
Mhm,
for them to actually know how to build a program or something. So I
mhm,
wonder, can you elaborate a little bit more about like, what would you say would be like the right moves for a younger person to build a program? Let's say like the so basically you guys have a lot of programs for
mm,
the people
yeah,
who were just started to get into the startup ecosystem, and like
right.
people who may be technical coming from big firms. And I wonder, like, how do you think about like what program to build to attract the
Mm,
most successful founders, both from like the people who are just out of school, also like people who already worked in the industry for a little bit. Like, how do you think about what program to build to attract these people?
mm.
Um, Also, how do you kind of like pick the right deals to invest out of the batch from that program that you've built?
Yeah, that's a great question. I think the one like positive trend has been that like over the years, VC funds are
Mhm,
building more platform projects and initiatives and accelerators, which is great. More support for founders, and
mhm,
also more competition means better products for founders.
mhm,
Like more competitive terms, and everyone is incentivized to increase the value of their offering. So founders can hopefully like pick between which programs they feel most aligned with. So I think in general, the idea of having programs is good. Um, my two bosses at Afore are both former product managers. You
mhm,
interviewed Gaurav, who's the first PM at Android Nexus at Google, and then Anamitra was the first product manager at Twitter. And so they
mhm,
think about everything that we do as like a product.
mhm,
Um, for example, say we're building like the founder in residence program, we should, before we think about what that looks like, we had a long chat about like what types of people are we looking to attract, and like maybe even considering them like design
mhm,
partners, talking with the
mhm,
person and saying like, hey, we're looking to invest in more people like you. What are some things that are helpful to you? And then working like very bottoms up from there, instead of maybe like slapping on some accelerator program saying, hey, everyone else is
mhm,
building an accelerator, we should do one too. Trying to figure out who do I want to build this for, and then um, yeah, what do they want to see? Maybe you'll have the answers. Maybe you can think, oh, I feel like they're going to want this, but the best way is just by talking with them and using them kind of as a design partner. And then I think the important part is also constantly reshaping the program based on feedback from people that have gone through it. Which again you do with a product as well, right? You collect feedback and then you figure out
mhm,
what features to kind of tweak or remove or prioritize. Um, I think if you're running any kind of cohort based program, my instinct is that it takes like at least three iterations of that before you start to really settle into a groove and land on something that works. So like if you try and run one fellowship or accelerator batch, for example, and it doesn't go as well as you planned, my recommendation would be counterintuitive, maybe to try and do it like one or two more times, because you're going to have learnings from the first cohort and then you're going to take those and improve the next cohort. And I think on the third time, or maybe fourth, you'll start to really settle into a good groove. So I would say like think about the programs that you're making as products, and then think about your products are supposed to solve a problem for an end user. So think about like founders as the end users and design it very consciously, um, you know, uh, uh, with their feedback in mind. And then the people that have gone through your program that get them to give feedback, and then the successful ones that will become your champions as well. I think will end up referring a lot of future people and making the program successful. Oftentimes, they'll say good things about the program to their friends, and then those friends might be the perfect fit for the next cohort. So I think it's important to support your internal champions and collect some testimonials about uh, how it went. And other founders, I think, will be attracted to founders saying, "Hey, I went through the program and it added a lot of value, and here are the specific ways that it added value." Um, yeah, and you can target founders, you can target investors. We used to run a program at Afore called Angel to Fund Manager, or AFM. And it was for angel investors who were making a bunch of great investments, and they were maybe considering raising a fund, which is very different from angel investing. A lot of overlap in activities, but also a lot of new skills that you kind of have to learn. So we tried to teach a cohort of angel investors, like, hey, here's here's what's different about investing out of a fund versus investing out of an angel portfolio, for example, portfolio construction.
Mhm.
Also, hey, here's all the like boring like back office stuff that you're going to have to do, and the best tools to use for that, so you can focus on your core job of investing. And a bunch of those people actually did end up starting funds, and now we're very friendly with them, because it was almost like making a pre-seed bet on an investor. It was like before they were like a fund manager, we kind of believed in them, and hopefully offered some good advice that they ended up using. So that was also a successful program, because now I think we're very tight with the angels that ended up raising funds, and we share stuff with each other. So yeah, the product can serve founders, it can serve kind of investors. The end goal is to invest in great companies.
I wonder, by the way, definitely let me know if you guys are doing the AI fund manager.
Yeah.
So I wanted to learn more about, like, let's say, I feel like one of the things that you mentioned really cool is like, as a fund manager, you have to think about portfolio construction. I
Mm,
wonder, how do you think about the program can benefit, like, I guess, like, how many people from the program, or
mm.
like, can you elaborate more about, like, for example, the programs that you've mentioned, the founder
Yeah.
program, how is it structured, and then, like,
Hmm.
how many people actually graduate into, like, a portfolio company, and,
Hmm.
like, do you guys kind of, like, calculate, hey, we want, like, the ratio to be, let's say, like, 10% people successfully become our portfolio, and
Mm,
we take ownership of X. Like, of course, you don't have to say what X
mm.
is. So, like, just, like,
Right.
generally, what's the thinking framework of, I guess, like, the ROI on these investments?
Yeah, totally. So the main program that we do right now, we're a normal pre-seed software generalist VC fund that writes,
Mhm,
usually $1 to $2 million checks. So kind of like small seed checks at the pre-seed
mhm,
stage. Pre-product is fine. But we
mhm,
also have a founders in residence program, which I'm
mhm,
running right now, which is um, 10 people, 10 weeks, a couple hundred K each to get to conviction on an idea, or get to traction on an idea if you already have one. Um, and it's less of an accelerator with like standardized curriculum that we push down everyone's throats, and more of
mhm,
like come work out of our office. Like, you get a key card, and you sit next to all the other FIRs. Hopefully you become pretty close friends with them, because there's only 8 people. And also, since there's only 8 to 10 people, we can provide pretty customized support. So we just try and figure out what people are struggling with each week, and like work very closely with them and make as many intros as possible. And the goal is to get a lot of customer discovery calls, which would be like, if
mhm,
you don't know exactly what the idea is, talking to people in the space and figuring out what their problems are, or customer calls if they have the idea,
mhm,
getting them on the phone with people that may or may not buy their product. So that's, and then we have a showcase at the end for the people that want to raise. We don't force people into raising if they don't want to. I think that's pretty important. Like, the overall theme of the program is to meet founders where they're at. So even if they're at the very beginning of their journey in the -1 to 0 maybe stage, we're definitely down to make a bet on the right people there and support them. Or if they have like traction or revenue or customers, that's fine too. Just not trying to give everyone standard advice, just giving people tailored advice. And if they want to raise at demo or at the showcase, we called it a showcase, not a demo day, for that reason. If they want to raise, they can make the pitch more, talk about the market size and stuff.
mhm,
Or if they're not ready to raise, they're going to raise in a couple months. That's totally fine, and they can just showcase their product. So with that program, we kind of invest upfront, because some people, maybe are just coming out of school, or just, need some money to quit their jobs and go full time. So in that case, we invest the money up front, and we'll always participate in the next round if they raise the next rounds. We're not going to lead the next rounds. We were trying to avoid signaling risk, where it's like, hey,
mhm,
we have 10 people, but we only invest in one of them. So then the VCs get scared to like look at the other nine. So yeah, we thought about that a lot, and we intentionally try to avoid the signaling risk. And what's interesting is like you asked about maybe like graduation rate, for example. I think it's super early to know after the 2 months who what does success look like. I think because these companies are oftentimes like 2 months old, so you might have to give it another like 6 months and then reevaluate. Hey, how was the cohort 6 months ago, and how are they doing? Do they end up raising? So yeah, I think we've improved over time. I would say just the companies um, that we're very interested in. I think this fourth cohort, which is going to start on Monday for 8 weeks, will be a really great cohort, and I think it'll be the best one yet from a programming perspective. I think we're figuring out like the programming. The people I think we've always been very blessed to have high quality people, but I think we're nailing the support and programming side.
How, I guess, like, what is it you mentioned, like, it's kind of like the founder have a lot of autonomy and they can
Mm,
just chat with other founders in the program. How do you pre-select these people? So obviously I met some of them, they're like amazing, they come from like
mm,
big firms. I don't know what's like, I guess, like the standard of um to getting into these programs. And
mm.
also like do they have to as you mentioned, like, they don't really have a product, and then I guess, like, would you have to pull them from your network as, like, "I identify this person, he or she is awesome," and or would you just, like, more of it taking from the inbound kind of,
Yeah,
like, pipeline?
yeah, good question. I think maybe there's the second part is like where do the people come from, and the first part is what do you like to see, I guess, in those people.
Mhm,
For the first part, every VC funded investor is so different in the way that they operate and also in
mhm,
what they're looking for. I think what we've gravitated towards at Afore, and we're very open and try and go into conversations with very open minds and talk to everyone and figure it out from there. But I think it's very nice to see people who can learn quickly and also ship quickly.
mhm,
Those are kind of two separate things. Uh, for shipping quickly, it's nice to see a team that has at least one person that's strong technically and can build and ship and iterate and like put a
mhm,
product out there, get feedback from customers, incorporate that feedback very quickly because it helps
mhm,
you find product market fit faster if you're able to like have very short like shipping cycles. But then there's some industries that are hard to do that in, like highly regulated industries, maybe like fintech, where it's a little harder to move fast and break things. But I still think you can identify if someone is learning very quickly. Like if they're
mhm,
talking with a ton of people, figuring out new insights each week, even if you can't be, you know, uh, signing up users and shipping like features left and right just because there's some limitations based on the industry. I still think you can figure out if someone is like a learning machine. So I think that's one thing that we like to see is like, hey, if your current product is not getting traction, the data is coming in and it's not really working, are you actually willing to iterate a little bit on
mhm,
products? Or maybe it's the go to market that's wrong. Maybe you pivot on go to market a little bit instead of, for example, being too attached to the idea. You want to like one of our portfolio founders calls it, I think, um, marry the market, date the product. You get attached to the problem space, and the product you're willing to kind of iterate around on a little bit. But yeah, that's what we like to see, I think, at Afore, and we're very open and flexible on backgrounds and age and other things too. But we do like to see that ability to find product market fit by learning quickly and shipping quickly, if
mhm,
possible. And people have come from all different sources. Uh, I was kind of doing an analysis on the people that I sourced and the people that were in the program last and where they came from. How did we find them? And it turns out there's no silver bullet. I think this is the case for sourcing in general for VC firms. Is like it would be nice to have one silver bullet, one method of sourcing that drives disproportionate,
mhm,
um, you know, disproportionately good outcomes. But at least for me right now, it might be different for other investors, especially more older, experienced investors. But for me, I think it involves just a ground game of trying to run a bunch of different strategies. I look at our cold inbound at Afore, and we split it up among the team. But Afore Alpha, which was our old program, not in effect anymore, but uh, we looked at 10,000 pitch decks over the last 2 years for that program. We looked at every one. And I do like looking at cold inbounds. I think one or two of the current founder and residence teams we didn't know at all. They just applied completely colds on the form, and we called them, did a bunch of reference checks, really liked them, and they're going to be joining the current cohort on Monday. So some is cold inbounds, some is recommendations from past founders and residents and
mhm,
portfolio founders. which is great. Some of them are cold outbounds, like on LinkedIn or Twitter, like just being in the DMs and seeing interesting tweet and DMing the founder. So it's really a variety of methods. I wish there was one method where I could say, all right, I'm just going to focus all my effort on you know cold outbounds for this certain industry. It works really well, but it turns out there are great founders everywhere. So not one silver bullet for sourcing it is what I've
Mhm.
learned for me personally right now.
I wanted to learn more about like when I see this a lot in like the younger generation investors. A lot of people are saying like, I would see something interesting on Twitter and then I just DM the founder. So
Mm,
what is like something interesting? I feel like if it was based on like how viral the tweet went, or like if like
mm,
a I don't know, like a famous person commented or like their thing,
mhm,
like does that means like it's gonna be like a good company? Because I feel like
mm,
I don't know. Like, I'm just curious on like what is sourcing on Twitter kind of like what is a
yeah.
vibe like what is a vibe like, and like is this like actually successful in terms of like the return from the return perspective?
Yeah, great question. I think you're gonna basically find people that like build in public. So
Mhm,
people that are like in stealth and shipping in private are probably not gonna be tweeting like every day.
mhm,
That's fine. There are some people building in public that are doing some really interesting things. I think a lot of people tend to reach out if it's like a product that they would use. It's
mhm,
like, oh, I would totally use this app. Let me DM the founder and would love to jump on the phone, maybe offer some feedback, and then also see
mhm,
if they're raising at any point soon. But offer feedback, maybe connect them with other kind of consumer growth people, provide some value, hopefully. Um, what I personally like just find interesting always definitely just cool projects for sure.
mhm,
Would I use this or oh does this seem like interesting? I feel like deviations from the norm, like when the founder has done something that is like very different that showcases a high appetite for risk. Maybe um, they built a project on nights and weekends and quit their job or dropped out of school or did something where it's like just a bit of a deviation from what a lot of less risky people might do. So, or if there's just something like really weird or interesting about their backgrounds or about the product that they're building, like something that really stands out, because there's a lot of noise I think
mhm,
on Twitter and everywhere. So if there's something that like is really different or stands out or is a deviation, that definitely catches my eye personally. But
mhm,
yeah, Twitter's a great place
mhm.
for people building in public.
I wonder, okay, so let's switch gear a little bit. So like one
Yeah.
thing I feel like actually I went on someone else's podcast last week and then they asked me the same question, which is like the background of successful VCs. So
Mm,
like some experienced VC would argue like, operating experience is like, oh, basically some VCs ideas are like some VCs are giving negative like useful feedback. So basically they would yeah, anyway, so but like I was like chatting with my friends on their podcast. Basically they were saying depends on like who is saying this, like, what's their incentive. So not necessarily like basically some people would argue like, VC with absolutely no experience is probably even better because of they wouldn't give you like they wouldn't dominate where you're going. And then like some of the VC gave that opinion, but like they built a product like literally 2 decades ago and like it's like not useful, blah blah. And I wonder what's your thought on like the background of successful VCs? Would they be
mm.
former founders, operator, and like career VCs?
Yeah, I think I definitely have a strong opinion on this. I think uh, c- I think Jason tweeted at one point a while back, like you need to be a founder first, then a VC, and then you can empathize. It's definitely the right idea. Like you can empathize with founders more if you have been a former founder. That's definitely true. I just feel like some of the best VCs of all time have come from such different backgrounds, and there's no blueprint to being successful. Like if you think it's going to study CS in undergrad, working software engineering, big tech, getting your MBA, starting a company, and then be like, there's no path, I would say, because some top VCs have come from journalism. They got really good at asking great questions, which I think is like probably one of the most important skills to have as an investor is like being able to ask like one really good question that gets to the core of the business and what the risk is. So yeah, journalism or career VCs, maybe from a firm like Battery or Bessemer, which is known to hire people young and promote up, from within. And if you make it to the top, you're probably have a lot of experience working with founders. You know how to give advice, but then get out of the way. Because this is we're not running the businesses. We're just kind of providing advice on the side and support. Um, so
I
career VCs, operators going from operating into investing, founders, it's all over the place.
I have a question on that. So
Yeah.
one is hi Jay, I want to say hi to the audience. So I wanted to say like one thing is like I've always heard like VC is such a mentorship business. So
Mm,
technically you need to like immediately find a mentor who would be willing to coach you, take you under their wing.
mm,
And I wonder, but like how do you really find the mentor? Because I don't think like most people have that mentor even within their like own firm sometimes. Like I think because
yes.
people have different skill sets and then like I wonder I feel like it would be really hard for people to actually accidentally just met that person and like actually the person have to be very good investor themselves and then be like they have to be willing to coach or they know how to coach. And how do you even educate yourself within the process of like learning how to invest? And as you mentioned, like you guys were running a program for like angel turn
Mm,
emerging managers. I've seen so many emerging managers, maybe they have great deal flow because of they come from X company or
mm,
Y background, or like maybe generally they're just very good on like building an audience and then raising from the audience. However, those don't really translate into investing skills. I feel like
mm,
investing doesn't like I feel like since I started this daily show this year, I've been very like intentionally trying to learn about like portfolio construction and
mm,
like how does the math work. And like I've chatted with a lot of New York based VCs that are very good at like talking about like how do you think about exit, like how do you think about actually what makes a good return. This will bring up to like maybe this will like just like also touch up a little bit on like the disciplined way of like doing pre-seed stage investing.
mm.
So like I guess like how do you really think about a like how do you learn about investing in general, like not just like picking a right founder that's like doing some really big thing, but also think about okay, so if we make like 10 bets, like what's gonna like what's gonna happen, like how many hit rate do we need to have to like actually still have like a fund 2 or fund 3 kind of thing.
Yeah.
Oh, hi
That,
LinkedIn
yeah,
user.
that's fantastic. That's a really good question. There's two things. One is about mentorship, and one is about like maybe the practice of VC versus investing and that sort of thing. I think so. For the first one, I think you're totally right, and that's something that not a lot of people realize. But you definitely got to the a core issue there is VC is supposed to be a mentorship based business. You're supposed to get a lot of reps in and fail, but you're supposed to have someone that's guiding you, maybe your direct boss, who's like taken you under their wing and is you end up probably adopting a lot of personality traits and investing styles from that person. I feel like this is completely anecdotal, but I feel like it felt like that was more the norm a while ago, and nowadays maybe there's just a ton of funds and a ton of managers and maybe a bit more competitive or transactional. I do feel like not many young investors that I know do have mentors or even mentors at their own fund, but that doesn't mean that you can't find mentors outside of your fund. I think the best way to do that is just to have as many conversations as possible with other investors and start to figure out like what do I like and not like about these people and the way that they do investing. They could be a great investor, but maybe you just don't vibe with them for some reason. Maybe they're too top down, thesis driven. You're very bottoms up and people focused. So I think it comes with
Also, I have
yeah.
a
Oh, go
question.
ahead.
I'm
Yeah.
sorry. I
Yeah.
wanted
Yeah.
to like learn more about like how do you judge who is a good investor? Because I feel like just because of certain people's like amazing social media following, or like maybe they have like one maybe let's say if they invest in Uber, but like they're like maybe the smallest stakeholder at Uber. So I don't really know like how it should be like judged based on like who is like
Mm,
a quote unquote good investor. Besides maybe like if they're a managing partner who raised like 10
yeah.
funds and then this fund are like absolutely all killers, obviously that's a good person to learn from, but I'm sure
Mm.
that person will be like so popular. How do you
Mm.
even get their attention? And if they're like the non-obvious people, and like how do you even like identify who actually have good returns?
Yeah, great question. So, like, the mark of a good investor is probably returns, right? At the end of the day. But uh, yeah, hey, Catherine. I
Hi,
think
Catherine.
returns aren't necessarily like published. People, VCs don't
Mhm,
necessarily publish their own personal DPI, TVPI,
mhm.
MOIC, I guess, that they've generated. But you can kind of figure it out too. You can look and say like, hey, this person invested in Datadog seed round or something. That's pretty impressive. And maybe you talk to them about it and you figure out, wow, this is how they sourced it and this is how they made the decision. And I really respect that. And then I think reaching out to mentors, you definitely have to do your prep. Maybe look at their past investments. Um, Maybe try and ask them a question about their biggest investment and then also their most recent one, and ask like, why did you invest? And maybe you'll be like, oh, that's great. Actually, this person thinks the way that I do, or I want to be this person in like 10 years. So yeah, the way that you probably judge an investor is based on returns, but that's hard to get. So maybe you just look at their portfolio companies and when they invested. Did they invest like when it was early and non-obvious? Like that's fantastic. Um, yeah, and then if they have a big kind of social media profile, it probably means a lot of people are hitting them up and trying to get in touch. So um, it's just like anytime you know that you're in a lot of a noisy field, like in college application essays or in like a pitch deck that you're submitting to a website where someone's just going to be inundated and like scanning, you have to say something that really like stands out,
Hmm.
that catches like someone's eye. So
Let's say if
yeah.
today we're sending a message to Mark and Jason, like what would be in your title?
Oh man. Yeah, that's a good. I mean, so I feel like, especially for really important, busy people, like they have, like I think I knew someone who worked on the chief of staff team at maybe BlackRock or something. The BlackRock
Mhm.
CEO has like a team of like 15 people that just like do the prep. Hey, you're sitting at this dinner. These are the two people next to you. Here's like one fact about each one of them. They just get like briefed on everything. So like if people are getting briefed on everything, like you have to come up with some like something unique, some like crazy insight. So I don't know, I would probably try and find the most interesting like piece of information I could find. Maybe it's like some insider baseball about what's happening in at a company or in an industry, or maybe it's just an observation that is so like interesting and striking that it'll catch someone's eye and they've never read it before. That's always the way to stand out in like, yeah, college applications, submitting a pitch deck on a website, cold emailing an important person. It helps to obviously write a personalized email, but I think the most important part is like saying something that's weird that they've never heard before, that like sparks a follow up, and the goal is just to have them follow up and then you figure it out from there. So no, yeah, I'm not exactly sure for Mark Andreessen specifically. Maybe, um, yeah, maybe some. I think they're trying to open up like a funds in the Middle East. Maybe I do some research and figure out some insights about what it'd be like to run that fund in the Middle East. Some LPs I know in Afore and some other funds have been based out there historically. So yeah, some insight about something that they're working on that really stands out and is surprising.
As for like, I wanna just like also double click on like a little bit what you said about like, let's say you send like the F4 partners before they like actually have a full on team, and then you DM them over Twitter, and then you DM him like 4 times. I wonder what
Mm.
is like the limit of like how many messages you have to send to a person to make sure they're like not annoyed, but also like eventually they obviously you're very successful at for today, but I wonder like what will be like the bar, like the norm of like people sending DMs. And what would
Yeah, it's
you
a good
even
question.
send each time? Like, would you have to like add value? You have to like do this and that. Like, and then if back in time, like the F4 team never got back to you, like
Mm.
how many message would you have to send until someone like got back to you?
I think the limit would be pretty high, even if it seems really annoying. I've had founders like do that where it's like on the like fifth plus sixth, like seventh email, and I'm like, oh man, yeah, it's you kind of see it, and you're like, I've been meaning to open it and check it out, but I haven't gotten in. So if they hit you a bunch of times, eventually you're like, all right, I should at least open this and figure out what it's about. Um, or you can always tell someone to stop if they're being too spammy. So if someone's not telling you to stop, I feel like you can go pretty far and send like a lot of messages. I probably would have kept going like past the fifth or sixth DM. And each time you're trying to bring something new. You're trying to like catch their eye each time, bring some new piece of information, or yeah, just get them to read the message and then be intrigued enough to like ask you what you mean, or maybe jump on a call to like follow up. So as long as you can keep coming up with new pieces of like really interesting information, then I think you can really hit people many times cold. And again, if it's too annoying, hopefully they'll just tell you to stop and won't hold it against you, because everyone's hustling, everyone's trying to reach out and talk to people. So
How would you approach them in the first meeting though? Let's say you had like the call with Gaurav, and like what would you say in the call to like kind of lead to like a second call and then to like having a role for yourself? And were they hiring, or what were was it just like a general call? And some of the VC firms, let's say like they looks pretty polished, like obviously they have like literally the best people coming from the industry. I feel like another thing is like a lot of people don't feel confident enough that like, oh, they're threatened by like a certain people's profile. I wonder, how do you like view like realistically, like, do I have a shot at X, or like do they have to be actively hiring? And if actively hiring means like it's too late because too many people are already on their radar, and how do you kind of like a soft approach these like kind of like in person or like online meetings when you land
Yeah,
them?
yeah. Good questions. There's a couple parts. So I think the first one, how to stand out on a call. Um, I think there's maybe two things going back to
Mhm,
like being very unique and saying something unique and standing out. Because if they're talking with like 10 people that day, you want to be like the one person that they remember.
mhm,
So that involves maybe being a little extreme in some way, like like going like having some really interesting piece of information, going really deep into a subject,
mhm,
something that is like memorable. I think that's the number one goal, is being memorable on in the DM, on the call. And
mhm,
then the other important thing is just to make the person like you and make the person, walk away feeling good. Maybe you match up with a person personality wise. Maybe you Google them beforehand, find out that they like Formula One, start talking with them
mhm.
about Max Verstappen or something. Establish some, some common grounds. And then someone also told me, like, a really good salesperson. People remember like the first 5 minutes and the last 5 minutes, or the first and last part of the interaction. So making
Mhm,
sure that you make a really good first impression, and then at the end, making sure you end it like very well as well. People are going to
mhm,
forget everything else in the middle. They'll just remember like how you made them feel. So if you make them feel like, oh, I really like this person, and then you also give them something memorable, I would say that's like my advice, best way to stand out on a call. Afore, I got super lucky because they just closed Fund Three. They'd gone in from uh, 80 million to 150 million. I think it was 78 million to
mhm,
150 million, and so they were just running it with two partners, the 78 million dollar fund, and then they decided, all right, this is getting bigger. We need to hire some people. So I think they were using the internship as a trial run, and I was also kind of trying to get to know them as well and see how they worked as a team. So that was second semester senior year. I just completely lucked out with the timing, and the full time offer. But oftentimes VC funds are not officially hiring; they're opportunistically hiring. And so it's always good to build up relationships, and people are very opportunistic. They'll jump on the phone and they'll be like, all right, well, we weren't officially hiring, but this person is incredible and we really want them to work for us. So I would say don't be afraid to reach out to people cold, even if there's no jobs listed on the website. And even if the person is like, you're talking about crazy backgrounds, like maybe you feel a
mhm.
little intimidated or threatened by their backgrounds. I think, yeah, just realizing like they're people as well, and they might have families, and they're probably in your exact shoes at one point, and they're probably really good at one thing, which is some part of their job. Maybe they're really technical, or they're really good at identifying opportunities before everyone else, and that's great. And they're probably looking for someone to train, or they're trying to find the next version of them. And so oftentimes, like really smart, talented, like more senior people are willing to jump on the phone with like young, hungry people. It kind of gives them energy, and
Mhm.
maybe reminds them of themselves, a couple years ago. So yeah.
Okay, so let's say you met like a team of people, and then like let's say you met like a partner that you really like, or they really like you, or like, well, the first meeting clicked, and then you are
Mhm.
landing a second meeting. What's your like, I guess like, how do you quickly figure out what exactly they want as a value add? Maybe like, I guess like the default is like bringing in deal flow, but what
Mm.
like, I guess like, how would you kind of like structure the deal flow? Like, would it be like you cold call, let's say like 500 people from YC, and then be like,
Mhm.
hey, you want to hop on a call with me about like a specific subject sector? Let's say you're climate investing, which is like hot these days. Like, let's say you're investing climate tech, and then you find out like, okay, among this like newest YC batch, there's like 30 people invest. Like, well, innovating in the climate tech ecosystem, and then you
Yeah.
cold call them and then be like, hey, here's like among the 30 deals, I think these five have like the best shot or something, and then you
Mhm.
bring it to that partner. Or like, how would you kind of like run like your own research, and then what would be like your way to
Mhm.
demonstrate, hey, I did my homework before I come to see you?
Yeah, that's fantastic what you just described. You can do my job better than I can,
Oh
maybe.
god.
That's amazing. I think because what you just mentioned, where you basically screen through a lot of things and then filter it down to a couple interesting ones. that does like it shows the person two things. It shows them this person can like have a wide top of funnel and call a lot of people, but also this person can be picky and like figure out the one or two like most compelling ones for them. I would narrow it down to like yeah, like one or two instead of five because um, you know, 5 feels like you're trying to throw stuff at the wall and see what sticks.
Mhm.
1 or 2 is like, I have deep conviction in these 1 or 2, and I would pound the table, for these like 1 or 2 companies. I talked with the founder. I really like them. I did deep research. So yeah, that method is fantastic of showing them that you can cover a lot of grounds and then also have good judgment and diligence and analysis and narrow it down to the 1 or 2 that you would say, hey, I would personally invest my money in like this one company. That's always like a very strong signal. It depends on the person that you're talking to. Yeah, again, one framework is like people might be more people driven or more like thesis driven. So if someone is more people driven, I think just sending them like, hey, in the past like month, here are the 3 most interesting people I talked to. They could be founders right now that are raising. They could be operators, like they're a strong software engineer that's going to leave their job and start something soon. Maybe they're even investors. Like, hey, there's this really, really good angel investor that like, here's why I think they're super special. So if they're people driven, just I think sending them interesting people that you met will show like, hey, I also think very deeply about people and I want to work with the best people and more flexible on what they're building in industry. If they're more like thesis driven, they really try and do a lot of analysis on a market before they make an investment and figure out where the white space is. Then the stuff that you send them might be different. You might even send them pieces of content. You can say like, hey, by the way, I got the inside scoop on what's happening at this company, and this company that you invested in, or this company that's in your thesis area. They might just want information, honestly. So I think it depends on what an investor is looking for. If you're trying to build a relationship with them, if they're people driven, you can send them people. If they're thesis driven, you can send them like articles and news and pieces of information. If they if they like second time founders, maybe you focus on that. If they're very like uh, they like hot takes, they're controversial, they're outspoken, then you got to send them some, you got to kind of bring the heat as well. If they are less like that, they don't like to be pushed as much, then you kind of tone it back a bit. And so, yeah, it really depends, I think, on the person and reading the person and figuring out like how to be, most helpful or interesting based on what they like.
Would you go, let's say, talk to their portfolio first, or like would you go to talk to like the general people in the ecosystem? Like why I'm asking is like I
Mm,
think if you talk to the portfolio, like you have like a better sense of like what they're looking for or what's working with them look like kind of. And
yeah.
then on the other hand, if you talk to like newer people, maybe you can bring like a fresh perspective. I guess like which one would you think would be like more important in the I guess like coming up with a thesis for the basically thesis font fit.
Mm, yeah, that's a really good question. I think you're asking really, really good questions. I think like yeah, portfolio founders are a great proxy because they've worked directly with the investor. They can talk about what it was like. They can talk about how the investor built conviction in the company, how quickly they built it up, what kind of diligence the investor did. Like, hey, the investor actually called some of my customers and genuinely asked them great questions. Didn't go in with any preconceived note. Like, so I think the founder can tell you like a lot just about the relationship, but also how they made the decision. Yeah, you can also ask other investors about the investor, but I think that's it's a little harder. It's more subjective. It's like
Mhm.
they seem good. I see them on Twitter a bunch. I had a couple conversations. So founders are probably the best proxy.
Okay, so let's like okay, so instead of talking about okay, I guess like we let's talk about like,
Mm,
the venture landscape in
okay.
the 5 to 10 years topic. Okay, so I want to add a little bit on this is like what's your thought on like building a successful fund? So like I
Mm,
feel like I've seen a lot of like successful emerging managers who are able to raise a first fund, but would you say like how many like I guess how do you even like build a fund, build a thesis in today's climate because I feel like it's very, very competitive as even like I the other day I went to like a demo day for like emerging managers and essentially I feel like people thesis is getting like nicher and nicher. Like it's just so niche. I wonder how do you like see what's gonna happen in the next 5 to 10 years and like if you're starting something new today, like what's gonna be your like TLDR on like I guess like what's gonna be your strategy on like stand out among the tons of like emerging managers in the world?
Yeah, makes sense. Great questions. Like forward thinking. So I think like uh, three things that help you raise a fund, and you do not have to have all three of these. But I'm saying like if you have all three, I've seen people raise funds like super quick. I guess with this like a track record, some sort of like interesting things that you've done in your backgrounds, and something like different to say, which would be your thesis, I guess. If you have all three, like that's fantastic. If you've worked at some really interesting companies, you've also angel invested in some great companies, and you also have something interesting to say, that's probably the best like combination. Or you could over index. Maybe you're a little bit newer, but you have something like you have a really unique thesis. Maybe you make that a big focus. There's a fixed amount of LP capital out there, and oftentimes they have a specific amount allocated towards seed funds. Like, hey, we're going to invest in 2 seed funds, and it's if it's hard to make room for someone else, they would have to drop maybe one of their existing people, or maybe grow their endowment by a certain amount, and then they have a little bit more allocation for. So it is super competitive. I think it's an interesting game to play starting your first fund because you want to stay disciplined and avoid the hype, but at the same time, you do kind of have to somewhat sell your like markups. Like, hey, these tier one funds are doing the follow-on rounds of my companies. That doesn't mean that they're going to be successful though. Only time will tell. But sometimes people go for that. They're like, we're going to invest in companies that we think the next, the Series A investors are going to follow on to. I think the best LPs won't care about that as much. They'll more care about just how the companies are doing and how returns are looking, and they're willing to be patient. So I would say, like, if possible, yeah, try and avoid the hype cycles and investing in just staying disciplined. I think in the future, and this is, I don't know if it's happened yet, but I feel like there's going to be the large multi-stage brand name funds, right? Like Andreessen and Sequoia and that sort of thing that can do early growth, large AUM, yeah, instantly recognizable brand name that like even like founders that are new to the industry will know them. And then there will also be on the other end, like small kind of boutique funds that focus on a thesis or stage or industry. And they've realized that they do like one thing really well, and they're going to stick to doing that one thing instead of trying to expand strategies and become bigger and compete with the brand name funds. I think the people that are in the middle might have a tougher time. Like you're either going to be a boutique, like this happens, I think, in investment banking and consulting and some other industries too. You're going to have a lot of the big brand name ones, like hire a lot of people and big AUMs, instantly recognizable. They provide a certain amount of value, maybe in like the brand name and other things. And then you're going to have the small specialists as well. And both types of people can do well. But I feel like if you're in the middle, you're trying to do a couple things, you're trying to compete kind of with the bigger funds and also with the specialist funds, it's going to be a lot tougher. So I would, you probably want to pick, you want to pick. And I also think maybe in 5 to 10 years, venture and startups has obviously been pretty hyped up and glorified. And I think that's good. It's like, it's good to some extent. And then also founders are realizing there's other ways to get capital and there's ways to bootstrap, and maybe like AI helps you build your company with less employees. And so you need less capital to raise. So yeah, I think, venture has endured many cycles. A senior kind of like partner at a big fund was telling me like they've been around for a while and they've read books, and what they've learned from books on the history of venture is like it's endured. There's booms and busts, and a lot of people are thinking like maybe VC is gonna like cease to exist, which is I think like obviously not the case. I'm optimistic that there are going to be ways for new funds to start out that will find alpha, that will find like something different, different approach, something different to say. I really like Afore, so I'm not going to start a fund, I think, soon. But if I were to, I would focus on pretty similar strategy to what we're doing at Afore, which is concentrated portfolio instead of spray and pray, early stage like pre-seed or seed, people focused, somewhat generalist, and if there were to be like one kind of edge, I would say I'm trying to get just better at people evaluation. I've seen a lot of really successful investors are just so good at asking the right questions on calls and kind of like figuring out what motivates a founder, what drives them, and honestly, like almost delivering the equivalent of an IQ test and an EQ test on a 30-minute call and making a snap judgment. That judgment could be wrong, but oftentimes it's right. Like you get an instinct about, hey, this person does seem like they've deviated from the norm and they embrace risk and they're a hustler. And I could tell that not because I asked them direct questions, are you a hustler? Like they're going to say yes, but just like kind of asking other questions. I'm not a fan of asking trick questions like puzzles and riddles. Like I also think that's just kind of silly. I think just asking normal questions and getting really good at like evaluating a person, I think there's a way to be very disciplined about that process. Is what I'm trying to say. A lot of people think that pre-seed is just like vibes, which sometimes it is. But I think there's a way to be disciplined about vibe investing, to do reference checks in a very thoughtful way, and to really understand a person and go very, very deep on that person. I think there's a way to do pre-seed in very disciplined ways. That would be one strategy. Yeah.
I guess like what's gonna be okay, so I have like wrote down some questions or
Mm.
like topics. I feel like one of the
Yeah.
things like how do you, let's say if you're an emerging manager and then you start out with like a niche of a niche and then you dominate that niche, how would you go to approach it to be like a generational
Mm.
fund? Because I feel like let's say if you're like a two people starting something and then like eventually becoming like a A to Z or something seems like very unachievable.
Mm.
What would be like? I mean, I'm sure like the next generation of like A to Z is not going to be like A to Z. It could be like some, I don't know, other like AI related things or um like other things. So I wonder how would you kind of like plan out the journey of what's, I guess like what's your thinking framework of like creating a generational fund? Because they obviously like for first round when they started, their
Mm.
insight was, well, this is like I read this somewhere, but like or like I chatted with people and stuff. Like so I've learned that like what they're seeing is like, they are inventing the venture model as like a founder to founder um communication. So like basically in the past it's like VC
Mm.
gave you advice, but now it's like if your portfolio founder gave each other advice. Maybe that's like a revolution.
Mm.
And then you see X and Z, that's like kind of like a media play. So eventually you build like a network to help the portfolio company grow. But like what would you see as like something that's gonna be like the
Yeah.
next generation
Yeah.
innovation in the venture ecosystem?
Great question. Yeah, that's a very, very interesting question. I wonder if you ask that to other people too, they're going to have some interesting responses. My general thoughts first is, if you're trying to build something generational, you said you're doing well at a niche, right? It's working. First thing I would do is consider not expanding AUM and just try and do that one thing really well and do it in perpetuity. Some people like Benchmark was doing pretty well, and then they decided to expand internationally and expand
Mhm.
across stages a little bit too, and then they realized like that they weren't necessarily the best at that. Now they were competing with the people internationally. They were competing with like people that would go later stage, and that's really tough. Like knowing when to stick to your core competency versus expand, I think is the first question I would ask. But if you're trying to expand, um, maybe you expand across stages, maybe you expand across geographies. What's interesting about venture is it doesn't necessarily scale. When you add people, it doesn't necessarily make the firm better. You have to have the right quality people. There's some of the biggest VC funds out there right now are being managed by very, very small teams. So it's not like in order to become generational, you have to hire more people and just do more things. I think it actually like you might even need to focus like a little bit more. I would say like the number one thing that probably matters in building a really good fund is just hiring like the best people, like the best young investors. Obviously, I think making good investments is the way that you get there. Like people will respect that no matter how you get there. But hiring the best people, I think, is really important. So that goes back to like evaluating people and figuring out what drives them. Like, but instead of doing this for founders, you're doing this for investors. You're thinking like, what is the next generation of who are the like a couple really young investors that I really admire, and can I train them and have them carry on the legacy of this fund. So I think hiring the best people really matters. And then the last thing that I'd say is even if you have an edge to start out, you're going to lose that edge eventually. People are going
Mhm.
to figure out what it is and they're going to copy it, and then you're going to now the playing field is leveled. Even funds like Sequoia are constantly like trying to innovate and coming up with new structures, and so I think that maybe is a function of if you hire really, really good people that are able to innovate and adapt and come up with new projects. It could mean innovating on projects. You could come up with new accelerator programs. It could mean innovating on the financial structure of your investments. Maybe you invest. Maybe you create a scout program, for example, or you come up with something else. So I think you have to constantly be innovating. Even the big brand name funds, I think, are they don't. It's not safe. It's you got to constantly stay ahead of the curve. And so whoever is really good at staying ahead of the curve, I think, has the best chance of staying or becoming a generational fund.
I guess, like, to attract the younger talent, what would you think the funds have to do to, like, kind of both attract and keep people there?
Great question. On the attract side, it's kind of tough because everyone's going to be looking for something different. I think you just have to be really good at like recruiting. Hire like a recruiting firm or just like do it yourself and just say like, yeah, just talk with a lot of people and then be very picky about the people that you kind of let into interviews and go throughout the process. I mean, because some people are attracted to brand name, other people are attracted to, I want to work at a company at a fintech VC, or I want to work at um, I really like moving fast and being aggressive, or I really like being very thoughtful and slow. It's so I think just again sticking to your core competency and doing what you do really well, and not like changing your personality or anything, or trying to like be something that you aren't. If you are just like really great at what you do, the best people will come to you. Um, yeah.
I wonder, okay, so I've also chatted with like some more seasoned investors, and like I feel like people were mentioning about like, there's a lot of like syndicate that's happening on like, everywhere like Angeles or something.
Mm,
Would there be like any type of like funds that's focusing on like, having people to like, I guess like not just operator, but like people, I guess like multiple people, there's like kind of like financial incentive that's like maybe for
mhm,
people to not staying for like 10 years of a fund, but like 3
mm,
years, and then like they kind of like collaborating on these things. I guess my question was like not, it's more of like, is there any like in between like, um
mm,
having like a syndicate slash rolling fund to like, basically operator on the side running like a fund. Besides these two options, is there anything in between of the emerging manager starting a full on fund versus like rollings or like basically
mm.
syndication related things?
Yeah, if you're at a VC fund right now, you either stay there or you leave. It's kind of hard to like you can't really run like a
Yeah, yeah,
syndicate
yeah.
on the side. I guess you can angel invest. Some firms let you do that. There's a lot of really good operator led funds like you're talking about, where it's like the founders of UiPath or something have a fund that they run,
Yeah.
or it's like the former founders of like Clearbit or something have like a fund where they basically have pooled their personal capital and are making angel investments. But it's more like a fund because they formalized it into like a fund. So yeah, there's very you're right. There's lots of different flavors of investing. You could do small angel investments. You could do syndicates, rolling funds. You could start your own funds. That is a huge commitment, right? You're committing yourself to a 10-year horizon, probably longer. If you want to make a fund two and a fund three, which you probably are hoping to do, then that's like even longer. So, yeah, there are lots of other steps before taking on the massive endeavor of building like a fund from scratch. It seems pretty like one of the harder things that you can do.
I wonder, so you mentioned about like being disciplined in
Mm,
pre-seed stage investing.
mhm,
What would you say would be the diligence process that you would use on funders? Obviously, like you mentioned about like reference check, and like I guess how many reference check would you have to check, and like what kind of question, or like who would you pick as like the reference, and how
mm,
would you kind of like run the diligence process, since pre-seed is kind of like betting on the people and you don't really have a lot to study on. And also you mentioned about like the LPs, maybe it's better like, the best LPs don't care if like a tier one firm invests in the deal like right after the next round or something.
mm,
I wonder what would be a good benchmark on a
mm.
certain, if certain company is like doing really well.
Yeah. So actually, any chance you could repeat the question? Yeah.
The first question is like, what's your diligence process like
Yeah.
for to invest in like a disciplined way for pre-seed stage?
Yeah. Totally. Yeah, great question. I think spending just a lot of time with the founder and asking questions and getting to know them as a person. It's good to know like what have they shipped and how many users has it reached, and it's also good to know like their origin story and their family situation and where they grew up and how that influenced like
Mhm.
how they think. Um, so I think that just comes with spending time with the founder. In person is best, obviously. Like if you can grab dinner or drinks with them, people kind of open up,
Mhm.
over a meal or breaking bread. Um, and it's usually like not at the beginning. You gotta like maybe like an hour and a half into the conversation, into the dinner. Like that's when the real stuff starts getting shared. So yeah, you want to spend time with the person, and I think there's some frameworks you can have, maybe some types of questions you can ask, but I think you also have to be opportunistic and not too frameworky about it, where you're applying like a criteria, to the same criteria to everyone, because venture is like a business of outliers. You're looking for like outlier founders and outlier companies, which oftentimes just completely do not fit the mold of what you might be looking for, or successful past investments. They kind of redefine, they create their own market, like this market, they expand it, or they create a new one, or they go about things in such a weird and different way. But that's why they're successful, is because no one has tried their method. And so if you have too much of a scorecard, or you're too standardized about it, you might miss some great companies. But it is good to have some loose frameworks. And I think those for me would be around just like figuring out what drives a person, and spending time ideally in person with a founder. There are a couple of founders in residence. There was one founder in residence that I sourced for this upcoming cohort, who we met in person at a happy hour, and then we called, and then I told him, hey, if you're ever in New York, you can crash,
Mhm.
on my couch. And he was like, oh, okay, I'll be there next year. Can I come for a week? And so I said, oh, all right. How many people have taken me up on it? So he came here for the full week and got to know him really, really well. We talked like into the late nights, many nights, and got to know his story. And he had an incredible story where he grew up in Italy, and his parents worked in a factory, and he's a self-taught engineer. And then he broke into startups in the US and was a lead software engineer at a YC startup at age 19. And really incredible background, and definitely a hustler. And you could only really get to those stories, I think, just by spending time. So reference checks are great too. Honestly, like going for volume, I think it's a bad idea to only reference check with like one person, because that one person could give you a negative review, but it's just because something weird happened between them. So I think, asking as many mutual connections on LinkedIn about the person is probably a good idea. Uh, Especially people that have worked with them. You can try and call like people that you're not connected to, like you can call their former boss or colleagues and ask like, what was it like to work with them in a work context? Um,
Oh,
did they
by the
pull their own
way,
weight?
like,
And
how do you
Mhm.
gracefully do that? Because I feel like if I were, like, checking up a founder's, like, ex-boss, maybe they're just closer with them, and they just be like, "Hey, by the way, this crazy person just asked me about you." What's gonna
Yeah,
I guess, what's, like, a best way to, like, not just be, like, the crazy person who DM, like, 7 people on LinkedIn about this guy?
yeah. I mean, I think the best way to do it, pretty just common sense, is just be very transparent about what you're doing, and just ask the founder, like, "Hey, can I reach out to your boss? Can you introduce us?" Oftentimes, the founder would be like, "Oh yeah, sure. I love my boss. We had a great relationship. She's probably going to say, or he's probably going to say great things." So yeah, just tell the founder like, "Hey, can you connect me with your boss or colleagues?" And they'll be like, "For sure, for sure." Or maybe they'll be like, maybe just reach out on LinkedIn, or you can tell them, hey, I'm going to reach out to your colleague on LinkedIn, just so you know, just keeping them in the loop so that it doesn't feel like you're ambushing them, you know?
Okay. So about like the okay, I wanna just cover this last question, and then we'll, like, have a 1-minute fire round, and then we'll call it a
Yeah.
day. Okay, so, I wonder what would be, like, a good benchmark for LPs to judge if a fund is, like, well performed? And I
Mm,
feel like I actually heard about, like, LPs just, like, paying attention to if tier 1 invests in these in, like, XYZ or something, or, like, if the valuation is, like, higher or something, but I wonder what would be, like, the best benchmark to judge these things? And then
mm,
if, a lot of LPs are looking at, like, who invests in your next round, would it be, like, the most critical, skill to have to just, like, be friends with, like, people at, like, top tier firm and then, like, trying to pass
mm.
along the deal? What would be, like, a good framework to use to actually make sure your investments are good to a degree?
Yeah, great question. I'll caveat this by saying like I'm not an LP, and so
Mhm.
other people would probably be better equipped to answer this. But my instinct is that you can look at markups like valuations, and how much, like that's always good. You look on paper like how well the fund is doing. You can look at funds that follow on. Yeah, tier one funds are doing the A. That's fantastic. LPs definitely look at that. It's a data point. Probably the best data point is just like, are they investing in good companies? Which means, are they investing in companies that are growing very quickly? And that you can just, that's probably more, you look at the companies and their revenue growth. Um, and oftentimes you got to be patient as an LP too. Like it might take like 10 years for a company to exit. So if you're looking at a company like 3 years in, it's still pretty early on in the company's journey, and they could come out of nowhere with a pivot, or just with like a shift in GTM, which has happened a couple times for us. Like you got to kind of keep faith. And so to some extent, I think you have to be patient, look for growing companies in the portfolio. Um, there's some other data points like logos that follow on, and markups and stuff too, and that's definitely looked at. But yeah, probably the number one metric is probably are you investing in great growing companies?
Okay. I will just keep the last question in 30 seconds short. Okay, so
Yeah.
if you are like, let's say if you're new to the ecosystem in Silicon Valley, you don't really know any like tier one firms, how do you kind of breaking into like or kind of establish a relationship with like the tier one firms?
Yeah, good question. Cold email and provide value and don't be transactional, but try and build a relationship. We hosted a seed and series A mixer at
Mhm.
Afore, basically to have some of our portfolio companies that were seed or series A, and then we invited a bunch of follow-on investors that were series A, series B kind of stage. um, I think we got a really great attendance. I think there were like maybe 80 people there, and more than that were RCP, but almost all of them were people that I had just cold emailed. So that like one event I think helped me build relationships with a bunch of other later stage Series A investors, and it was all cold emails. And hopefully this is like providing value. But I basically said, hey, awesome background at this place. I checked out your profile and it's pretty cool. We should jam at some point. But in the meantime, like we're doing a showcase of our portfolio companies in SF. It's right by you in South Park. You can walk over after work, and then you can meet like 10 of our portfolio companies that are going to be raising Series A's or Series B's like in the next year or so. So it's hopefully you can provide a little bit of value, and then they come, and then you can kind of talk to them, and I think talk to a lot of people and figure out who you really resonate with, and then focus on building up a relationship with those people.
Mhm.
I think a lot of like young investors and founders and people our age are great at like talking with a lot of people, but not that great at like building relationships like with a small number of people that they feel like they really connect with. So I think focusing on that and being genuine and less transactional and jumping on a quarterly call to share deals, and more like let's grab dinner and get to know you as a person, and things will come up. But you're probably going to send like the most interesting companies in your portfolio to the follow-on investors that you've gotten drinks with and you like as people, and then you'll think about the other like transactional ones too. But yeah, just yeah,
Okay, so we'll end it with a 1 minute fire round. What's your
yeah.
favorite book?
Um, the Book Thief. Yeah,
The Book Thief?
yeah,
Not 0 to 1, I'm just kidding. So,
yeah, yeah. Exactly.
who made the biggest impact in your career?
Um, my friend M Herrera. She's at Slow Ventures right now. She was the one that convinced me to become a VC and not a software engineer. I was going to try and be a software engineer, and she told me, "Don't do that. You need to do VC." And she was right.
Who would you invite to your dinner party?
Masa's son. He's like huge, like contrarian. I feel like that would just be a crazy dinner to have with that guy. Or
Wait.
Walter Isaacson, the guy that wrote the
Oh
Steve
god.
Jobs and Elon Musk and all those books. He's just he goes so deep on those people, and yeah, has to have some really interesting stories.
Where can we find you outside of work?
Yeah, just bouncing around in New York, and I like grabbing dinners and drinks with friends, and I DJ a little bit on the side, so mostly other friends' parties and some small venues and tech events. I
Uh,
also really like nature and hiking and stuff in the outdoors.
Amazing. What's your content diet look like?
Sorry, content.
Content diet? Like
Yeah. I really like the Acquired podcast. They do like very deep business breakdowns. I like stuff that goes very deep. It's also good to listen to stuff that covers like the broad range of what's happening. But I also
Mhm.
like my favorite content like goes very deep on a company or a subject or a person.
Awesome. Jack, thank you so much for coming on the show today.
Yeah, thank you as well. Really, really great to be here, and you asked really fantastic questions. I feel like you would be a great investor.
Thank you. Okay, let me
Yeah.
just